where are the compounders of the future? What is required for a compounder? You need growth. You need high returns on invested capital. If you think about it, where is that going to happen? Well, from a business perspective, it has to happen in areas that are growing. So that's digital technologies or companies that are adopting technologies that make their products better and faster and cheaper.
So for today's interview, it's for our YouTube channel. I'll be interviewing Edwin to learn more about his background, his experiences, and his investment approach. And Edwin, I know you've worked in a number of different jobs in investment management throughout your career, and just given you just a vast amount of experience. And most notably, you worked at Franklin Templeton for many years as a portfolio manager before starting your own firm in 2021. So although you're very much a fundamental investor today, you actually started your career as a trader, more focused on things like technical analysis. Right. What did you learn from that experience in trading, and how did that impact you as an investor today?
Well, trading was very interesting because when I was growing up, I thought trading was the way to make money in the markets. So I had this passion to try to learn how to make money with money. And so in 1986, 1987, I put on my first trade. I traded options on IBM. I never forget it. And I basically tripled my money in one afternoon. And I was totally hooked after that. So going into that, I said, you know what, this is what I really want to do. And fast forward to 1990, I started CL trading with a partner of mine, Frank Casey. He was more senior to me. I was actually an intern for him at Prudential Beige. So we started this CTA, or Commodity Trading Advisory, based on technical analysis. And the great thing with Frank and I, we started this business and we traded everything, anything under the sun. We traded treasury bonds, cocoa, wheat, corn. So it was a lot of fun. However, as we progressed, I found that the performance was a bit volatile. So we're up 10, 15% in 1 month. We're down 10 to 15% the next month. We're trading futures contracts and they're levered and there's minute by minute type of ticks on the market. So probably after about 6 months to a year, I found it exhausting, the emotional swings. And I said to myself, there's got to be a better way to make money. It just wasn't for me. I think some people are very successful trading. And it wasn't for me just because of what I tried it. The performance didn't progress, and I said, I need to learn how to do this in a different way. Then I left CL trading and then eventually decided to focus more on fundamental analysis.
And how did you ultimately get into sort of this fundamental-based or value-based investing style?
Yeah, I think I said to myself, okay, what is the best way to move to the next level, to deliver the returns that I would expect of myself? You're talking to someone who watched all the programs, who read books on great traders, great investors. And I said, I want to be like them. What is the better way? So one of the things that led me to fundamental analysis was, the first thing I did was, I wanted to get in the money management industry, but I wanted to get in a more formal environment. In other words, working for a money management company. So what I did was, as I was going through this, I realized I had to go get my MBA. So I went, I applied, got into Columbia, took the Columbia MBA. That's a value investing course, and that appealed to me a lot. And then after Columbia, I said, I would very much like to move forward and find a firm where I can do some good training. They have the idea of training, so I didn't want to work immediately for a hedge fund. I wanted a firm where they take the time to train their interns and employees. So I joined Templeton. They offered that opportunity. Moreover, it was in Fort Lauderdale, which was even better for a kid out of New York. And so I started in Fort Lauderdale, and I learned the basics as an analyst. And what's interesting, on the side, privately, I did a technical analysis to see how that would go. But on the other side, I was practicing the fundamental analysis that Templeton was using. And it was just so much more superior, and the returns were much greater than my technical analysis. And then I switched and I adopted. And that's when I was hooked on fundamental analysis. But then, of course, as you know, Templeton is a value-based manager, started by Sir John Templeton, I think in the early 40s. And it was always a value investing format. So that also appealed to me a lot.
Wonderful. Well, you did a stint at Franklin Templeton from 96 to 2002. Then you were portfolio manager at Brown Capital for 4 years before transitioning back to Franklin Templeton in 2006, and you worked there until 2021. So quite a long stint at Franklin Templeton. altogether. And to my knowledge, this firm has over $1 trillion in assets under management. Is that right?
It is. That's right.
In 2006, you were put in charge of $100 million in AUM, and that amount grew to over $6 billion in 2014. I'm curious just to learn more about this, experience in terms of how does one grow AUM by that much? And talk more about that.
Okay, yes. At the time, it's interesting. Franklin Templeton today is over $1 trillion after the acquisition of Legg Mason. But I was there before that. But nevertheless, going from 100 million to 6 billion in assets was the secret sauce. Really, is good performance and an amazing marketing organization, which is what Franklin Templeton is. So you need the two pieces to really get to the end, not only to grow it so quickly within 4 years. So I think, first of all, when I joined, let me step back a little bit. I joined rejoined in 2006, and I joined a team, and the team got lifted out. So I was left there, and Franklin Templeton came to me and said, let's get a small team together, see if you can build this whole thing back. And then I had 100 million spread across 3 different funds. I had an international small cap fund, I had a European small mid cap fund, I had a global small mid cap fund. So those 3 funds, 100 million, and practically no performance. So at that point, number one step was to build performance. And in this field, you need at least 3 years of performance to see how you do. That's the first step. Secondly, while I'm trying to build this performance with this small team, we're talking 2006, 2007, 2008, we had the crash, and we actually did quite well relative to the benchmark. But more importantly, I had to market myself internally. So I had to put myself in front of the distribution channel for the mutual funds, the distribution channel for the platforms, the distribution channel for the separate accounts, or the institutions such as pension plans and endowments. So there were 3, if you will, paths to raise capital. And so as I was developing, and after 3 years and going in front of people and trying to deliver performance, we actually had good performance after 3 years. So it started getting noticed. The mutual funds started becoming attractive. The platforms started inquiring. UBS, Goldman Sachs, Merrill Lynch, for example, those big platforms. Our fund goes on their platform, and then their fund then gets sold to their high net worth or wealth management team. And then, of course, the institutions, the consultants started coming to us and started inquiring about our product. And what's the interesting thing about international small cap in general is that it is a capacity constrained asset class. So what I mean by that is we're investing in small companies. There's not a lot of liquidity. And as a result, most managers get up to about $2 billion and then close. So if you're a $100 billion pension plan who wants to put a 5% allocation to international small cap, what ends up happening is you're putting $5 billion across many managers. Some of them have 5, 6, 7, 8 managers, and they keep closing. So when they saw us doing well, there was a lot of interest to fill us up, if you will. So we also planned to close to about $2 billion. But as we started getting closer to $2 billion, so step back a little bit, money started coming in, performance is good. All of a sudden, we're getting up to that $2 billion mark, and we decide to start telling people we're going to close. First step is a soft close, so we do that. And then as people realize we're closing, actually more money came in. So the point was it's a great time. It was a time where performance was good, money was coming in, and we actually peaked at $6 billion if you include the cash flows plus some of the appreciation that we had in the stocks. It was a fantastic period. So that's how we got from 100 million to 6 billion.
Yeah, you mentioned sort of 2 aspects of growing AUM. You look at, the performance relative to your benchmark or the benchmark that some of these pension funds and whatnot are looking at. Then there's also just the marketing aspect. And of course, I see a lot of the marketing side being a host of this show, and a number of guests will constantly be reaching out to me and the other hosts. And some of these guests, they might sound good. They might be good marketers, but then I look at the performance and it's just not as interesting. And I'm reminded of Monish Pabrai. He once made a comment that if you're outperforming the market over, some number of years, you could be out in the middle of the ocean and investors will be figuring out a way to funnel money to you. That in itself is such a good way to market your firm. Have you found that to be true, over the years, and, the people you've talked to, and in the way the Franklin Templeton funds have grown?
Yes. So what Monish is saying, having the assets and building that up, what's happening now is that the field is very competitive. And the idea of if you build it, they will come is a good concept. It applies, I would say it applies more to me now, that as long as I have good performance, to your point, that the assets will come over time. The issue is how fast you want to grow, is the question. So if Monish wanted to, and I know he doesn't from basically what he said, he can easily start hiring salespeople, marketing organization. He can easily raise money pretty quickly. So, but I know he does not want that. I wouldn't want it for my own firm as well. So it just depends on the firm and how aggressive they want to be. I joined Franklin Templeton. You talked a little bit about Brown Capital, and I switched over to Franklin Templeton. I had the same opportunity actually at Brown Capital to build the Brown Capital International Service. But the issue there was, it's a great firm, but the marketing, I wanted to get bigger at the time. I wanted to get into a platform, and I knew it was going to take a very long time. They eventually did it. I mean, looking back now, 20 years? They have, I believe, $2 billion in international, maybe more. So, but I want to grow quicker, so I switched to Franklin Templeton, trying to get into a platform where I can grow assets faster. And subsequently it happened. But to Manish's point, I like what he says today, which is, as long as you do well, it will come. And I think over time, as long as one is patient, and Brown Capital proved that one is patient, that the assets will come over time, giving good performance.
Mm-hmm. You talked a bit there how, if you're an international small cap fund, you're limited to some extent by AUM. You can't grow that sort of fund to many, many billions. And I mentioned you took the AUM you were overseeing at Franklin Templeton from 100 million to 6 billion. And I think that sort of forced your hand a little bit to change your investment strategy. So from my knowledge, you had shifted from this high quality investment approach over to cheaper companies. So maybe you could talk more about that transition and what you learned from that experience.
Yeah, it was a good experience. The lesson there is quality delivers performance. That is the lesson. I went back 15 years of data because I had 15 years at Franklin Templeton, and went back in the beginning and see what really caused our outperformance in those first 3 or 4 years. And it was really buying high quality small companies overseas that had high returns on capital, that were growing. And those are the businesses that really produce a lot of value. And then in 2014, to your point, I said, we did very well. These stocks are getting expensive, 35, 40 times PE. Then I said, I asked my team and myself, and we said, let's look at companies that are cheaper and see what we can find. And so we started investing in cheaper companies. However, the negative was that they were of lower quality. And there's 2 components to that. One is cheaper, so you're thinking you're buying stuff at a discount, 50 cents on the dollar, or whatever you like to say. Moreover, which I found attractive, but having low quality companies at 50 cents, the issue was that they could barely keep up with the benchmark in terms of the quality of the business. So as a result, the lesson there was our performance started fading from 14, 15, 16, 17, going into 2021 because of these lower quality businesses. And so I realized that it was quite harmful during the time. So we sold stocks, got into the cheaper companies, and that cost us performance. Now, I also believe that the second piece I wanted to mention was that value was coming back. And that I thought could happen, but it just never happened since 2014. And today, I take those lessons and I exclusively focus on higher quality businesses. And that's what I decided to do going forward. Growing businesses able to reinvest those returns, great management teams that are operationally effective, but also very good at capital allocation. That is a key component because the management teams really create that value. So that's what I've done over the last 3 years. Performance has been very good. I've actually been having better performance with lower volatility, buying high quality names. Finally, I think over time, I can even improve the performance from here by slowly selling out of the lower quality stuff and buying the better quality stuff. And so that's my goal right now, is to continue along those lines.
Mm-hmm. And it's interesting. I think when many people look at the data, they'll say that over the long run, value investing tends to perform the best. And that's sort of a I think it's led to many people, following this sort of value investing approach and sacrificing quality and seeing underperformance in recent years. I'm curious to get your take on if you see it almost as the game is almost fundamentally changed where just quality is the way to go.
Yeah.
And, higher quality businesses are delivering most of the returns nowadays, or is it a factor of finding an approach that works for you and suits your temperament? I'm curious to get your thoughts around that.
Yeah, it's a good question. I actually think it's both. I spent a lot of time pondering this question just personally. And I say both. First of all, let's just talk about how markets do evolve over time. And I think we see it, even Ben Graham alludes to it in his writings, how markets have changed. I remember reading or looking up some of his quotes early on and how he first started with buying companies that are their market cap is less than their net working capital, doing that, net, and finally realizing over time they no longer worked when he gets into his 1973 edition of Intelligent Investor. So markets do change over time. I see that happening all the time. And I think you had a wonderful person on, Adam Cecil, with his book, Where the Money Is. And I thought that was very, very interesting. And it speaks to that, where you have value investing 1.0, 2.0, and 3.0, which that resonated with me a lot because, as we know, valuation 1.0 is that cigar butt, net working capital, realization of value coming back over time, which I think it's just less and less available nowadays. It's just hard to find. And part of that 2014 experience that we talked about that I had was that kind of thinking. Value investing 2.0 is when Warren Buffett starts buying growth companies, knowing that there's a lot of return in those growth companies that Adam talks about. And I thought that was interesting, buying the Coca-Cola, buying Geico, buying See's Candy, buying those better quality. And then finally, valuation 3.0, value investing 3.0 is, I find itself interesting, is when we start moving into Buffett buying Apple, for instance, so getting into digital technologies and so forth. And, if we step back and say, okay, let's think about the markets and where are the compounders of the future? So what is required for a compounder? You need growth, you need high returns on invested capital. Where are they located? Think about it, where is that going to happen? Well, from a business perspective, it has to happen in areas that are growing. So that's digital technologies, in my mind, or companies that are adopting technologies that make their products better and faster and cheaper. So moving in that direction, I think that's where the future is. And to think about it even further, it makes a traditional value investor like myself. Remember, I grew up at Templeton, so this is traditional, very traditional value investing. I realized, I said, well, it's a different accounting standard, if you will, for new businesses growing. It's not the old days, as you know, of buying plant and equipment and growing the business. It's really businesses that have little capex, and most of the investment is coming through the P&L. So it's hiring salespeople, it's hiring programmers, it's doing advertising. And I think that's flowing through the cost, and that's what's really growing these businesses. And we see that with Amazon, for instance, which is a company in our portfolio. So, and finally, I'll say one more thing about the differences. I think another way that has evolved is easier to get information. There's few mispricings in the market. There's more participants, more money in the market. That's what you see now, and there's actually instant access to in-depth knowledge, especially with AI and so forth. And in-depth knowledge actually is readily available in the markets. I think now it's easier to discern between higher quality and lower quality businesses. As a result, it drives the demand for better businesses. Therefore, you're going to have that constant higher valuation on better businesses and constant lower valuation on lower businesses. Don't get me wrong, there could be a few exceptions, but this is something to think about. So I think the key in finding an undervalued business going forward, a high quality business, is thinking 5, 10, 15, 20 years out. So what does this mean in practice? It means Markel. Is Markel Insurance going to be the next Berkshire? Is Tom Gaynor, CEO Tom Gaynor, putting everything in place to be the next Berkshire Hathaway? So those are the questions that are going in my mind. Constellation Software, is it going to end up in the next 5 to 10 years as a disparate group of spin-offs? Small companies that can grow faster. The problem, as we know, with Constellation Software is that it's already generating $10 billion in sales. For a business that constantly makes acquisitions, small businesses of 5 to 10 million in revenue, it's impossible to keep up the 20% growth rate on 10 billion of sales. So what is Mark Leonard thinking about? How is he addressing the problem of growing his business going forward? What is he doing going? So this is what I think. And why is the business undervalued? Is because the business is going to look different. It could be 5-6 times bigger, or in the case of Constellation Software, 5 to 6 times smaller in smaller pieces that actually are growing faster individually. So these are the things to think about. Is Amazon going to be the online marketplace of the world? That's another question. Is Jeff Bezos putting the infrastructure in place to see that? I mean, from what we've seen, he definitely wants to grow internationally. So that's why I think markets have changed and how to look at it going forward. And then finally, the piece, I don't want to forget about the last piece there. The answer to the second part really, is it more suited to me? I think it is. For me, it's that constant learning. I think it's, for me, investing over decades is ideal. I like to constantly learn and understand the business better and better over time. It gives me much more confidence. And I think that's critical. I think the idea of value investing 1.0 and 2.0 is important to know, but I think the markets have changed that we have to move on and go to the next level. And just to step back a little bit, value investing 1.0 and 2.0 is more trading, more activity. And even Ben Graham talks about this in a way. I found it very interesting. I'd love to give you a quick quote that I found in a 1973 edition of Intelligent Investor. And one thing that Ben Graham found is that he made most of his money actually owning Geico, as you know. It's actually Geico was a growth stock at the time. And in the book, he says, and I quote, "Ironically enough, the aggregate profits accruing from a single investment," that's Geico, "far exceeded the sum of all others realized through 20 years of wide-ranging investing and operations in different specialized fields involving much investigation, endless pondering, and countless decisions." So I think he even speaks to that in his 1973 edition. So for me, it's much more suited to this environment. So it's a good question, though.
Yeah, that's all wonderful. I'm happy you mentioned Adam Ziesel, and one of my takeaways from him in his book is just this idea of mean reversion. So maybe companies 50 years ago might have had more of a tendency to mean revert, whereas he makes the point that like brick and mortar retail, what sort of mean are they going to be reverting to as they get totally disrupted by Amazon? It's so difficult too, just because there's so much nuance in investing. You can't just apply these basic rules to every single company. Each situation is unique. Each situation is different. We'll be talking a little bit about our mastermind community a little bit later, but I was on a call yesterday with one of our members, and he was talking about his experience investing over many years. And he also shifted from this looking at cheaper companies to focusing more on quality. And he mentioned an example where he bet big on a company that was trading at 30% of book value. And he saw that the size of that company just shrink and shrink and shrink over time. So what looked really cheap, in hindsight, actually wasn't.
Yeah, no, I've been there. So that I've had that experience actually not too long ago, and it was actually brutal to buy a company thinking that it will increase that extra, the down 30%, maybe go up 60% in value, and you just and it just continues to go down. So I've been there. I definitely sympathize with that individual.
All right, so you started EL2 Capital in 2021. I'd love to learn more about this. What was your motivation for starting your own investment firm?
Yeah, the motivation there was I really wanted to continue my passion. This is the same passion that I had. And what is that? That's producing above average returns for myself and for my partners. And that's the same passion I had since CL Trading in 1990. It's just continuing to learn and continue to grow and really trying to deliver those returns. And I think I'm getting closer and closer to achieving that goal. It's not really a goal. It's probably a constant learning process, but it's something I truly enjoy and I want to continue doing it. And when I started CL Trading, I want to build a structure around the process versus mutual funds. When I was working at Franklin Templeton, they have a great operation, but the problem with those structures is that they have the business structure and then they implant the mutual fund, then you implant the process on top of the mutual fund, which is a different way of going around it. So do it the other way around. I created a fund now that we can just concentrate on the best companies. I think that's important. I think that's where the alpha is. We talked about that already. And I think you had a wonderful guest on not too long ago, Professor Henrik Bessenbinder, which was fantastic because, as you know, he did a study from 1926 to 2016. There's been, 26,000 listed stocks in that 90-year time frame. What's interesting is that when I looked at that, I said, it was a wonderful study, and it's 65% of the stocks, of those 26,000 stocks, underperformed the T-bill rate. So now when I look at companies and I have my buy list, I said, more than half of these are going to be garbage. So I looked at that. I said, so number one, be very careful before you have a stock pick. Number two, the other part of the study showed that 4% of the stocks delivered almost all the value in that 90-year period. So that's 1,000 out of the 26,000 stocks that did all the heavy lifting. So my job going forward is really to focus on those 1,000 companies or those 4%, which I know they're out there. And that's why the portfolio's EL2 Capital, we have 13 stocks, we have 2 funds, and 13 stocks in each fund. So it's very concentrated, and it's just focusing on the best companies, because at the end of the day, there's not that many around. And I'll say one more thing about EL2 Capital. Building the structure around the process, you also need clients that understand. So having partners that are long-term minded, partners that understand that when markets go down, it's an opportunity to invest more. And having the partners, the process, and then the structure in place, the goal there is obviously to grow the business over the long term. That's the whole idea behind EL2 Capital.
And one of the things that stands out to me is you implement 2 different strategies. You have the international small cap focus fund and then the global opportunities fund. And, many of these kind of family office type investors I speak with, just have one strategy. They're focusing on a, very select few number of businesses. Whereas you have 2 different strategies and there is some crossover between the 2. So why did you ultimately decide to implement 2 different strategies?
Well, I decided to do 2 different ones, mainly because, first of all, I spent 15 years at Franklin Templeton doing international small caps. So that's a specialized kind of asset class, a product class, and I really wanted to transfer some of that knowledge. I believe I have some kind of competitive advantage there. So I want to make sure I maintain that fund. And I think it's a specialist product. So if there was a family office that had an array of investments, they can put international small cap into one of their buckets. And that's the way I'm thinking about it as a product. But it's also my specialty, so I want to keep that. But outside of small companies outside the US, I also said, well, there's actually wonderful companies that are not international small cap, that don't fit in the bucket. So there's Markel, there's Berkshire Hathaway, there's Union Pacific, some of these other companies, and I wanted to be able to invest in those. So that's why I created Global Opportunities Fund, and now we have the 2 different products going forward. So that's the whole thinking. Now, Global Opportunities can invest in anything around the world. There is some crossover between the 2 funds. I want to try to keep it below 25%. But there are just great large cap international companies. There's great small cap US companies that we definitely want to take advantage of.
And is your firm just you as of today?
It is, basically. I do, it's me mostly on the research side, and I do have one person, Marty Steineck. He helps me out on the marketing side. He's listed on the website. So Martin is, he also has about 30 years experience in the markets, and he's very good with touching base with high net worth individuals.
Yeah, and I mean, I can't help but think, this is a big change going from a firm like Franklin Templeton to starting your own firm. Presumably at Franklin Templeton, you had, an army of compliance people, you had analysts supporting you, and all these people around you with a ton of experience that you've now gained. What has that experience been like, working with presumably a pretty large team to just being you and your marketing professional?
Yeah. I mean, I think it's easier than I thought it would be, transferring. You're right. I mean, there's analysts and compliance and so forth. And what I found, the first thing is you can easily get third-party providers that provide all the back office. And it's scalable. The smaller you are, you pay less. The bigger you are, they scale up and they charge you more. But you can find, I have a third-party provider that handles basically all the accounting for each partner. And on top of it, everything's online. So each partner can just get online, look at their statements, get their K1s. It's very efficient. So that part is the easier part. The part that I had a concern with was really research. When I'm sitting there managing a team of 5 research analysts, information's at our fingertips. And because we're Franklin Templeton, we get any research we want from around the world and whatever broker that wants to give us an update on the company. So that was the part I was concerned about. So then when I left, I started looking around, and I found that the internet is extremely useful. And this goes back to your early question, has markets changed? There's just so much more information out there. I'll give you a quick example. When I was investing in TerraVest, I found the idea basically going through the internet, and there was a presentation that's on the internet that was part of a larger presentation on there was TerraVest presentation, part of a larger presentation, and TerraVest was maybe 8 pages of the total presentation, and it went in depth in explaining why that business was attractive. We're talking this was out there, I want to say 2010, 2011. And then it was subsequently updated. I believe it was back in 2022. And then, so this is quite interesting. And on top of it, 2024, Chris Waller, you've spoken to him before, Chris Waller, who had a presentation, who had put out a 40-page report on the internet. So you have this wonderful, you get these large reports. It's amazing what you can find on the internet. I think the other area where I find ideas is groups. There's services out there. One of the ones that I really, really enjoy is In Practice. They're based in the UK. They do a fantastic job. First of all, they focus on high-quality businesses and expanding and growing over time. And within those quality businesses, they do the scuttlebutt research. So they have interviews of management teams, maybe not at the top level. They do have it at the top level, but also in lower level management teams, division heads, for example. And it's very helpful understanding these businesses. So that's proved to be an invaluable resource. That's very helpful. It's a fee, of course, but it's certainly worth it. And then, believe it or not, there's services out there like Seeking Alpha, where they have some reports that are fantastic, some maybe not so good. But nevertheless, for example, in Union Pacific, I can go in there in Union Pacific, and they have individuals that have been following Union Pacific and give you ideas and details about the railroad industry. And going back to the internet, there was a big hedge fund report on Union Pacific that was fantastic in describing all the details of why the management change should take place. And this, I believe this was 2022 or 2023, and it was over 50 pages long. So you find these wonderful resources. So research, and then you mentioned earlier, we'll talk a little bit about, but TIP Community has been extremely helpful.
So you gave a presentation for our community some time back that I thoroughly enjoyed. Yep. And in that presentation, you mentioned intelligent fanatics. And that was something I was exposed to because of Ian Castle and the great work that he does related to that. Yep. Talk more about intelligent fanatics and how that ties into the types of companies you're looking for.
Sure, yeah. So intelligent fanatics, I think it's resonated with me a lot because the issue is that you can have a great business, but you need a successful management team, a management team that thinks in terms of capital allocation and so forth. And I think the name of the book is Intelligent Fanatics Project, How Great Leaders Build Sustainable Business by Ian Castle and Sean Eddings. And I thought it was interesting because it really gets into the characteristics of a person or a management team that needs to take place to create lots and lots of value going forward. It's the underpinnings of value creation, essentially. And I'll just touch on the list real quickly. I just think it's important because this is the underpinnings of a lot of I think about and what we look at. So first, we can start off with a CEO or management team with large ideas and a fanatical drive to build their moats, willing and able to think and act unconventionally. Immediately, you can think of some managers, right? We can think about Jeff Bezos and Sam Walton, and then individuals that are focused on acquiring the best talent, able to create sustainable corporate culture and incentivize their operations for continual progress. They think in 5 to 10 year increments and not quarterly. They tend to own large portions of their business. Regardless of industry, they can create a moat that competitors fear. They decentralize, so empowering the employees, and of course, they're experimental. So I think that list itself, to find individuals or management teams with that, can create a lot of value. And I look for those types of individuals. And one of the things while I'm doing research, how do you find out managers actually think this way and act this way? Well, you can see it in the results, but more importantly, trying to understand the culture of a business is critical. And one way I do it, which I think is very helpful, is there's a lot of books on a lot of these characters. So there's a great book on Jeff Bezos, Invent and Wander. There's books on Sam Walton, and there's books on these different various managers that are extremely helpful, or articles. And you can really try to start understanding the culture of the business. So that's what I think about Intelligent Fanatics.
Yeah, and some of those points tie into moats. And I think when I first started investing, I always thought that a moat was just something one company has that other companies don't have. So maybe it's a patent, maybe it's just Google having this search technology, or Union Pacific having all these railroads.
Yeah.
And I've been surprised by the number of companies I come across that have been strong outperformers.
Yeah.
And you look at, okay, why is that? It's just, it's their culture, and it's their ability to continue to think long term and just execute day in and day out and attract a culture of excellence. And it's just simply the way they do business. And it's this self-reinforcing effect where, people think long term, they behave honestly, they deliver value to their customers and whatnot.
Exactly.
I'd be curious to get your thoughts more on this subject of, the moats of the companies that are in your portfolios.
Yeah. No, I agree with you. First of all, I also focus on patents and toll roads and scale and oligopolies and low-cost providers. So that's definitely there, and that's important. But to really get the value creation, it's the individuals. And I never forget it. I going back in history, I remember looking at a company that was a toll road, a virtual monopoly, and the stock never performed. And you say, well, why is that? They have everything we just talked about. And the problem is the management team would just awful at capital allocation. They take the cash that they generated and just put it into bad projects. So that's one issue. And I actually found that the best companies in many instances are in very, very competitive industries, which you say, well, wait a second, that kind of defeats what we just talked about. And, for example, Amazon with online retail, that's highly competitive and extremely brutal doing online retail. Discount retailing, the same thing there with Costco. And then we have Berkshire with insurance. Insurance is a horribly competitive business. You can include Markel in that as well. They just do it better than anyone else. And I think we get back to the Intelligent Fanatics, and that the moat is actually embedded, to your point, in the culture and in the people.
Yeah. And for a value investor that likes to see, hard numbers, it's hard for some people, I think, to fall back on these qualitative factors, something you can't point to, something you can't touch, or even something with Amazon, like their network effect. You can't put a value on a network effect that's just totally intangible. It's something that you need to study and better research and see how that develops over time and how that impacts their business.
Yeah, that's exactly right. And you see that a lot with Amazon.
Mm-hmm. I actually did want to talk a little bit more about Amazon. So I read your Q4 investor letter, and I was a bit surprised that Amazon's actually one of your larger positions. I just looked it up. The market cap today, as of the time of recording, is $2.4 trillion, and we've talked a good amount about international small caps. And Amazon's, of course, an amazing business with no doubt more growth ahead. Yeah. And in my mind, it's only a matter of time before the law of large numbers starts to kick in, and it just becomes difficult to compound and outperform. I'd be curious to just hear more on your take with Amazon.
Yeah, no, you're right. 2.5 trillion is huge. It's a huge market cap. And even if you look at their sales, 640 billion in sales, this was 2024 sales, can they actually triple or quadruple from here? And I think, it's a difficult pill to swallow just on the surface. I think if one has to look at Amazon, one has to break down the different business lines. Now, you mentioned third-party resellers, and I'll go through some of this. I think there's two things we need to touch on Amazon is, first of all, the growth, and then the operating income. So let's just talk about growth first. And in growth, let's just take the retail business. This is online retail. It's 250 billion in sales. And if you add on the third-party sellers that are on the Amazon platform, that's 400 billion in sales. So 400 billion of retail sales out of the 640 billion in overall sales. So now you have 400 billion. Let's just take that and say, okay, what is that 400 billion? What is the addressable market, right? Because Amazon keeps grabbing share from the retail market, not only online, but also the tangible retail market, let's put it that way, with hard assets. So the US retail market is about 7 trillion in size, so 400 billion makes it about 6% of that figure. And then we know there's a pretty good sense that Jeff wants to go global. He already is trying and working hard at it. So if you go global, that's 28 trillion in retail sales, so still less than 2%, the 400 billion over 28 trillion. So of course, not everything can be sold online, but that's kind of the addressable market. And we're still at small numbers. And then I think, to your point, if you look at third-party sellers, that's a very interesting network effect taking place there, at least in my mind, because what we have is we have companies going on. First of all, Jeff is making the process easier, better, and cheaper for Amazon customers and for third-party sellers. So as more customers get on Amazon, more third-party sellers get on Amazon, and it becomes a virtuous circle. And I believe that network effect can get bigger and bigger and bigger because it's not Amazon sales, it's really other parties going on Amazon to sell their products. So that can be much larger in my mind. Let's take a look at advertising, another business line they have. That's 56 billion out of the 640 billion in sales. And even the global advertising market itself is 800 billion. So that's what they have, roughly 7%. Now, what's interesting about this type of advertising, a little different than other types of advertising that's been more traditional advertising. So Amazon, Meta, and Google continually gain more and more share of the market. Why is that? Because they show customers. So if I were to advertise on Amazon, you actually get to see the return that you make for every dollar investment that you make into ad. It's targeted customers, it's returns that you can see, how many clicks you get, and the interest in the products flowing through. So there's complete transparency. So this is a wonderful way to do advertising, and it's a superior product at the end of the day. That's why they continue to gain more share and more share. So I think, again, the addressable market is much larger on the advertising side. Now let's take a look at Amazon Web Services, or AWS. AWS itself is just growing. It grew 19%. It's now $107 billion of sales, and it continues to grow. Why does it continue to grow, and how big is that market? Well, how big is that market is still hard to tell in my mind. I just think the growth is there because just organically, the need for storage, the need for from a personal level, taking more pictures and storing more information, businesses needing to store more and more data and more documents and more information, that's just expanding the demand for cloud services. In addition to that, now we have the overlay of artificial intelligence, which is growing it even faster or adding more pressure. In fact, I saw this on Google's announcement where, as you saw, that they underreported the cloud services the growth was less than expected. And Sundar called out, I believe it was him that called out the fact that they were actually capacity constrained on the cloud services. And it goes to show how much demand that is for that product. And I think that's going to continue going forward in all the investment that will need to take place. So that's the growth on the AWS side. Now, let's just jump into profits real quickly. They did 11% operating margins back in 2024. That's 68 billion of operating income over 640 billion of sales. So 11%. And now, if you were to take out AWS, let's just put that aside for a second. What's left over? So you take out 107 billion, and you're left with roughly 530 billion in sales. And what is that? Now, if you look at Amazon 10K, they provide that information. They break it down as North American online sales and international sales. That's what basically they do. Now, and they give margins for each of those, and then they give margins for AWS. So this bucket of North American and international sales, 530 billion sales, has 29 billion in operating income. Now that's 5%. 5% operating income in a business that within it is embedded. You have advertising, you have subscriptions, you have many other things embedded in there. So let's just take a look at advertising. So it's shown as 56 billion in sales. Now, advertising, you think about it a little bit and say, well, you know what? They got a platform that gets 100 million hits a day. So that's quite valuable. Most of those revenues from advertising will probably fall to the bottom line. What are those margins? 90%, 80%, 70%? Well, let's just say 50%, right? Because again, most would agree that most of that falls to the bottom line. Even if you add a 50% margin, you're going to get to 28 billion in operating income. So first, they report the 29 billion in that bucket, plus if you add the 28 billion, this is assuming Amazon gets to a steady state. The reason why we're not at those margins is because they keep taking that cash and reinvesting and growing the e-commerce platform. So you take advertising, so that's 20, and then you go into subscriptions, and you say, well, that's 44 billion in sales, and you say, well, for subscriptions, there's probably not much in terms of costs for subscriptions. I mean, this is your Prime Video and Amazon Prime subscriptions, and that's 44 billion sales. And you say, well, okay, well, Ed, wait a second. That does include, Prime Video, and so there's some content costs in there, and there's some music content costs. So what is that? Well, that's $19-20 billion in 2023, which was half of their 40 billion in sales. So let's say, again, a 50% margin. So now you're adding another 22 billion in operating income. So now if you go 29 billion reported, plus 28 billion from advertising, 22 billion from subscriptions, now you're talking 79 billion in operating income. Again, steady state Amazon, which is not the case today. You're talking potential for 15% margins on a business that they report 5% margins. So just thinking through that process, you can see kind of where the value is being created in Amazon. And on top of this, as you know, they continue to grow quickly. So there's a lot of value. And I'll end it with this part. It's also run by Intelligent Fanatic that we're talking about, with Jeff Bezos experimenting and the whole idea of cash generation, capital, like he's fantastic at capital allocation. And what's interesting, if you look at the Amazon 10K, well, let's step back. Most of the time when we look at I look at 10Ks, you see the first thing you see is asset and liabilities, then you see a profit and loss statement, and then you see the cash flow statement. In the case of Amazon, it's completely reversed. Cash flow statements first, you got profit and loss second, and then you have assets. It gives you a sense of how Jeff Bezos is thinking. So I think basically it's the best of all worlds.
When I pull up some of their numbers on FinChat, it's showing 59 billion in net income, 115 billion in cash flow from operations, and a whopping 83 billion in capital expenditures. So Amazon, even as one of the largest companies in the world, is significantly reinvesting back into this business. And of course, you mentioned a lot of their investments happen through the P&L as well. So, they're not doing, massive dividends like a lot of these big mature companies would do. But 83 billion in CapEx, I'm curious to get your thoughts on how you're assessing this. Of course, they're doing things like building fulfillment centers globally, but they're also making major investments into data centers, AI and whatnot. That's seen just a substantial ramp in spend. And some people are debating what sort of return on invested capital these big companies are going to get on these sort of investments. I'm curious to get your thoughts on how you're assessing this significant level of reinvestment.
Yeah, it's a very good question. I think there's two views on this. First of all, I think about this quite a bit. Let's just take the traditional view first. And the traditional view is overinvestment leads to overcapacity, which leads to, at some point, when lower demand happens. And we know tech is cyclical. When the economy slows down, there's cutbacks on hardware spend, there's cutbacks on subscription spends. So that's something to think about. And however, there's another view which Sundar talks about, which is if you don't invest the CapEx, you won't be able to be competitive. He talks about there's more risk in not investing the CapEx, and that even if things were to slow down, that the capacity will be used up over time. Now, you can debate whether or not we should believe that. And to your point earlier, I still debate in my head whether or not they even know what the returns are going to be on this business. That's a huge question. And so when it comes to Amazon, I'm thinking, okay, how should I assess this? Of course, I'm probably going to take view number one, take a more conservative view, and understand that, first of all, the exposure to Amazon, the areas that they're going to, and also know that there's going to be a slowdown at some point, sometime in the next 5 to 10 years. I don't know for sure if there's going to be a slowdown, but I have to assume in my numbers and my thinking that within the next 10 years, there's going to be some kind of correction. And Amazon will get hit, given the business lines and given the areas that it is cyclical. It's something to think about. So that's included in my calculations when I think about Amazon. So that's how I come to, it's still an open question. It's a difficult answer, and I guess time will tell in terms of what those returns are going to be and whether or not that's going to happen. So that's something that we have to keep in mind.
Yeah, and I don't know if you think about it this way, but I think it's interesting to have a portfolio where you have some of these bigger companies that can almost serve as anchors. You know, we can say with pretty high levels of certainty that 5-10 years from now, Amazon is still going to be a good business. Like it's not going to be a big substantial drawdown. Or you could say the same with Berkshire and Markel.
Yeah.
Whereas with some of these small cap names or these companies where it's maybe hard to get more information on them or get more certainty around it, maybe they have more potential upside over the long term, but you still have these other companies that can almost sort of serve as a ballast where they're going to continue to deliver at least good returns. Maybe not these explosive upside scenarios, but helps provide more of a balanced portfolio. I'm not sure if you think about it that way at all.
Yeah, I think that's a good question too, because, when I look at this, I said, well, the small companies that I have, definitely the recession piece plays in there, and, the danger of those companies getting into financial problems during downturns. And what I try to do is look for companies that are in an industry that is less volatile and less sensitive to economic swings in the smaller companies. And I do think about offsets. So, for example, in the portfolios, when I'm thinking this through, yes, I might own cyclical Amazon, but it's offset somewhat maybe by more steady Danaher or steadier Constellation Software, to your point. So I do think about that, just thinking about a little bit more and trying to make sure there's a balance, because there will be a time when the recession hits, and we want to make sure we're in those businesses that can offset some of that impact. So I do think about that.
Another piece I feel that I've learned over the past few years just about great businesses and quality investing is that many great businesses tend to surprise to the upside, and they continue to do that. You don't know which quarter it's going to be where they just have a total blowout quarter, just where they exceed everyone's expectations. Whereas on the flip side, with some of these nets or very low quality companies, you're just waiting for that quarter where they just totally surprise you to the downside, and the stock tanks 10% on earnings or whatnot. And that thought makes me think of Topicus, which is a crossover holding between you and I, and they've made a big splash in terms of capital deployed in 2025. So based on some of the numbers I've been seeing, what they've deployed year to date here in 2025 has far surpassed what they've deployed in years past. And here, as of the time we're recording, it's February 13th, so we're not even 2 months into the year. So they've had some sizable acquisitions in terms of their bread and butter VMS companies, and they also took a large stake in a Polish software company that's publicly traded. They announced they're taking ownership of 25% of the company. And it's just a great example where, assuming they're able to get a high return on capital like they have historically, it's a great example of a great business continuing to just surprise people and delivering in a way that most people probably wouldn't have ever projected for 2025.
You bring out a very important point, because what I found is with Mark Leonard, who runs Constellation Software, which then owns a stake in Topicus. Let's go back to the term intelligent fanatics. Underestimating intelligent fanatics usually is a wrong strategy, I found, because to your point, you get surprised on the upside because they're constantly looking for ideas, looking for ways to invest. They may go through a lull or a quiet period, but then all of a sudden, to your point, all of a sudden you have those investments. You talked about Topicus. Topicus, one of the subdivisions is called TSS, or Total Software Solutions, and they're based in Belgium, and they actually was the one responsible for acquiring Topicus.com, which then they renamed that entity Topicus, which is traded on the Canadian Stock Exchange. And what's quite interesting, the recent investment I thought was, I'm just thinking through that because it takes, Mark Leonard and his team have obviously known the company for many years, and they continue to work and just took a stake, to your point. when I think about, you're talking about Asseco Poland, which they took a 25% stake. And it's a business where they have, back then, Adam Goral, I believe the name is the CEO, for years made acquisitions across Central Eastern Europe, Southern Eastern Europe, and Israel. Israel Formula Systems is one of their biggest subdivisions. So they have a big exposure to Israel. This is Asseco Poland. And they generate $4 billion in sales. So it's a big, big operation. And to take a 25% stake, which I calculated quickly, their stake cost them about 408 million euros, if I did the calculations correctly on that 25%. What's interesting is that Topicus bought that 25% stake at 85 zloty a share. Divide that by 4, I think you get to, 20 something a share, and in US dollars. So 85 zloty. Today, the shares are trading at 130. So I think they made their 30% in probably less than a few weeks. But the reason what's happening here, the investment case for Asseco Poland, which is actually quite interesting, is that they have done this before with Signity, which is a small firm based in Poland. They've already made it up. They've acquired most of the firm, 73%, and they continued and they did best practices. And Signity was a terribly run software company in Poland for decades. I think it's been around since 1991. And finally, when Topicus came in and bought a stake, you see the margins, the profitability, the growth starting to take off. This was recent. This was 2022 going into 23. In 2024, they implemented their acquisition program. So they made 2 acquisitions, and sales have already gone up over 31% in Signity. Now, let's talk about Asseco Poland. People are beginning to say, hey, wait a second. They've done this with Signity. Let's bring in best practices. Now, Asseco Poland it's well run in the sense that they do have good margins, and they're very spread out. They made over 140 acquisitions ever since they've been around. So it's a really large business. It'll be interesting to see how best practices are implemented by Mark Leonard. And this, to your point, will give Topicus a massive growth spurt if they're able to execute. I'm just thinking, Topicus is what? Just over $1 billion, 1.3 billion in sales, in euros. They report in euros, but they list on the Toronto Stock Exchange. 1.3 billion euros in sales, and they're taking a 25% stake in a business that has 4 billion euros in sales. So you can see how Topicus is thinking through this. And again, underestimating Mark Leonard and his team is probably a mistake. So I think the investors today, if you look at the stock chart of Asseco, first of all, they're trading at, just recently they were trading 18 times PE. And we know that everything Mark Leonard touches goes immediately to 30 or 40 times PE. So I think you've seen a massive PE re-rating at this point. And who knows, it looks like it's going to continue, at least for the next few weeks.
And just for full disclosure, you do own a stake in Signity, is that right?
I do, yeah. Own a stake in Signity, own a stake in Topicus, also own a stake in Asseco Poland.
Wonderful. Well, earlier when you were mentioning resources you like to use to research companies and whatnot, you mentioned the Mastermind Community, which is a group that TIP started and put together for entrepreneurs, private investors, and portfolio managers. And that's actually how I connected with you and got to know you. So you connected with me in late 2023, and it's just been a wonderful experience for me to connect with some people who are invested in companies that I'm interested in. And just another one thing I've just beat the drum on many times before is just surrounding myself with just wonderful individuals has just been so great for me. And I mentioned crossover holdings. We have I believe 4 crossover holdings. We got Topicus, Lumine, Constellation Software, and Dino Polska. So whenever news like what happened with Topicus comes up, I can talk about it. we can talk about it. Right. And I'd be curious just to learn more about your experience with the Mastermind Community and how you found it helpful as an investor and maybe even as a person as well.
Yeah, no, I found it very helpful. Let's talk about investing first, because I was actually surprised, and I'm getting a lot of value out of it. To your point, first of all, just step back, the culture, the community, the people. We all think in kind of long term. I believe we all have a culture of the love of learning, which I think It's wonderful, combined with the fact that we're all thinking of investing in higher quality businesses, and we have a long-term view. And I think those are key components of the culture. And from a business perspective, it's been very helpful for me. I mean, we had an interview, at the management interviews have been extremely helpful. Now, you got to remember, it's really myself on the research side on my business. Marty helps me again with the sales, but on the research side, to have a meeting where all of a sudden you get a management team, like we had Brett Kelly from Kelly Partners Group showed up on, we had a discussion with him. That was fantastic. As you know, Kelly Partners Group is one of my larger holdings. We had Lawrence Cunningham come on. I know you recently did a podcast with him, and he's fantastic. As we all know, he's the director of Markel Constellation Software and Kelly's Partners Group. Great to talk to him in the mastermind community and get more insight in how these boards kind of work and the thinking behind them. And then sharing research. I think we all share research. You mentioned, I think you mentioned earlier in terms of luxury, working with Lance, who, luxury is one of those growth areas that I'm very interested in. And you have Lance, one of our members. He's fantastic in terms of he worked in the industry. And I did a presentation with him, working together on Brunello Cucinelli, which was fantastic. And I learned a lot just working with him and Brunello Cucinelli itself. It kind of pushed me to dig a little deeper and work a little harder. And then we had the presentation of MasterCard with Wyatt, another holding on the Global Opportunities Fund. And you have these this helps a lot in, my research bandwidth. Yes, I only overall cover 26 companies, but you're constantly searching for new ideas and actually the research pool is actually bigger. But the point is you have these wonderful people, smart people, and it's a mix of people. You have people who are very experienced, and then you have on the other less experienced. But I think the mix, the culture, and we all learn from each other. So I think that's been fantastic. And to the other point, for me, it's great to develop my personal skills, improving my own interests and improving myself by learning from the group. And I think it's a wonderful group.
Yeah, I mean, sometimes I feel like the investing world has somewhat consumed my life. So each week I do research for a conversation like this. I'm recording, I'm going back and listening through before it's published. And, I've done that every week for over 3 years now. And
wow.
So one thing I really like personally about the mastermind community is that I'm able to connect with like-minded people and potentially talk about other things. Maybe we'll talk about business or personal development or personal relationships or fitness, for example. Just before we hit record, I was asking you about your fitness routine because, despite having so much experience in your career, you look quite young, to say the least. And I can't remember where I read this, but I saw that one of your favorite books is The Magic of Thinking Big by David Schwartz. And I came across this book because Preston Pish, one of the co-founders of TIP, recommended it, and I picked it up and read it, and I just loved it. And it's one that I'll occasionally revisit just for inspiration or motivation on certain things. And so I love that you mentioned that it was one of your favorites as well. So out of curiosity, we also talk about books occasionally in the mastermind community. So I was curious if you could just talk about the impact that book had on your life, because I think it's one our audience would enjoy as well.
Yeah, no, I mean, it's very impactful. I think there's a couple of main points I got out of the book. I think the first one is called Action Cures Fear. That was very helpful to me. It resonated especially with me because, just in terms of my personality, in terms of, everyone has strengths and weaknesses. And, when it comes to meeting new people, more specifically, let's say, I'll give you an example. I had to meet a new client and I may hesitate. I may sit there and say, should I reach out to him or her? Or is this someone that, maybe I should wait? What is he or she going to think about me? What's the reaction? This person's a close friend. I don't know if I should ask. So, these questions resonate in my mind. And what that is really the fear, right? There's some kind of fear component in there. So then after I read the book, it's Action Cures Fear. I said, you know what? Let me just take action. And I did, and the fear went away. As long as I take action, I feel much more accomplished now, and I don't hesitate. If I have a thought in my mind, let's reach out to this person, boom, I reach out right away. And that's been very helpful to me. And Action Cures Fear is just this, it's in many small instances where that really, I tell myself that, and it really helps out a lot. The other part is the that I found interesting is write down your ideas. Now, I know, I've heard this before in many areas, and it's, yes, but I didn't practice it. And they say, oh, always keep a notepad by your bed with a pencil. And, well, I don't keep a notepad with a pencil by my bed so I can write down a thought that appears in the middle of the night. I do have a cell phone next to my bed. So after reading the book, what I did was, okay, you know what? Let me send myself emails. So I write myself an email, put down the ideas, and then the next morning when I get up, my ideas are on my page as I go through my emails. And I found that's the best way. And that actually helped me out a lot too, because it's opening doors, because I do come up with ideas. A lot of them are not worth a grain of salt, but others are actually quite helpful in terms of helping me get to the next step, reaching out to different people to move the platform forward. And so, especially running your own business, ideas are critical. And I think the book highlighted two of those things that would help me build a business and, of course, try to be a better person going forward, because this also applies to the personal field.
I mentioned asking you about your fitness routine before, and you said you work out around lunch, and I can see so many benefits to something like that. Like a lot of times, like I have a trail right behind the place I live, and
nice.
Whenever I take a break for work, I'll go outside and just walk on the trail or whatnot. And it's amazing to me how often just these new ideas spark in my mind when I'm just out on a walk or out exercising or whatnot. And I think it's no coincidence. I think a lot of the people we meet in the community are interested in things like fitness and working out or whatnot, because one area of life feeds into the other area of life to a large extent.
That's right. Yeah, that's right. And I think fitness is important. As I mentioned earlier, it is the fountain of youth. and when I work out, I really enjoy working out because, to your point, you get to get your mind off of work, and it just puts your body and mind in a different realm. And I can't tell you how many times I come up with solutions and thoughts and better ways to do things while lifting weights. Or I like to get on the bicycle. It's a cycle in the gym, and I get on there and start doing my cardio, and it's amazing what comes up in the mind, because I think the mind needs to rest and get away from the day-to-day office environment, which I think can be actually counterproductive sometimes. To your point, going out for a walk. In my case, my office is in Westport, Connecticut, so I'm literally a 5-minute drive to the beach. So I get out, I drive to the beach, and I can read and I can think better. Get away from the office and come back at a later time. But to your point, I think it's important to do that.
Well, wonderful, Edwin. I mean, I really appreciate you joining me here, and super grateful to have met you and built a relationship with you over the past year or so. And you'll be going to Omaha here soon. So here in a few months, we'll be hosting some events around the Berkshire Weekend in Omaha. And you mentioned you've been to Omaha since 2006. Is that right?
2007, yeah.
2007, yeah. I mean,
so we're going close to 20 years, so that's good.
Yeah, that's awesome. I mean, for those in the audience who haven't been, I would highly encourage you to go. You have the Berkshire meeting on Saturday, and then there's plenty of other events around the meeting. So I'll mention I'm hosting a couple of events for our mastermind community. We have a couple dinners and socials, and on Friday we're doing a little tour around Omaha to see Buffett's house and some of the other things. But my colleague Sean O'Malley is also hosting a couple of free socials on Friday and Saturday. So I mean, if anyone's interested in that, they can reach out to Sean or click the link in the show notes below. But Edwin, I wanted to give you the final handoff here.
Sure.
For those viewers who are interested in learning more about you or your firm, how can they get in touch with you?
Well, I think, first of all, the website's always a great place to start, EL2Capital.com. I think it's great. You see the history and you see my letters. They're all going to be there. They're publicly available, my letters. And of course, anyone who wants to contact me directly can always reach me at elugo@EL2Capital.com.
Well, I really mean it. That I appreciate you being an active member of the community and accepting the invitation to come on for this interview. I really appreciate it and thoroughly enjoyed it.
Yeah, thank you. Likewise. Thank you. Thank you, Clay.
With my looking at both, where everybody, Buffett included, wants both value and growth. I want growth, and I'm prepared to live with some slippage on value. The 9, 10, 11% grower just doesn't interest me, because with all the stuff that's happening in tech, there is enough out there that's growing at 15% a year.